Hi there, this is Christian Dye from Latitude West Financial. Today we're doing our Financial Planning 101 for New Families webinar. I've got a guest, Ryan Runte from Stonehouse Realty, and he is going to give us some insight as to what is going on in the real estate market. If you've got questions, leave them till the end. I'm happy to answer as many as we can. And then when Ryan's portion is done, you could ask him any questions as well. Just a disclaimer, this information today is not to promote the buying or not buying of any real estate or stocks. We advise that you do your own research. Today is just educational purposes only. So what we're going to be talking about is a little bit about investments, how to get started. We're going to talk about real estate, and especially with our very, very challenging market here in the Lower Mainland, and field as many questions as we can for those of you who are young families starting out. So I'm going to start off by asking several questions. So here's the first one. What is the biggest mistake individuals and couples make when starting their financial lives? And this is my answer. They end up having, they have to understand the difference between rich thinking and poor thinking. So I want you to think of someone who is a rich thinker, which I'd like everyone to be, versus a poor thinker. And it's kind of like a thermostat. If you set a thermostat in the room, let's say 72, and it gets very cold outside, then the heaters will kick in, try to get you back to 72. If it gets really, really hot outside, the air conditioner will kick in, try to get back to 72. So rich and poor thinking are very, very similar. Think of lottery winners. They suddenly get this big burst of money, but then over time, they start doing foolish things with it. And then they say, when you study lottery winners, a lot of them have lost their money after, maybe under 10 years. Same thing with really, really rich thinkers. And all of a sudden they're wiped out and they lose all their money. But, again, over time, they sort of get it all back. That's because their temperature gauge of money is set to a certain standard. So high income spenders, people who, spend a lot of money, they often think that, well, if I make more money, then I'll suddenly be better off. But what they find is they actually just end up having higher debts and they get worse off. So people who make $50,000 a year, and then they start making 100, then they start making 200, but they don't get ahead because their temperature gauge was poor all the way. So one thing I'd like to say is people need to learn to adjust their financial thinking. And that's what this workshop is here for, to help you to adjust your financial thinking, the way you approach everything, the way you approach money, the way you approach investments, the way you approach real estate. What we want to do is we want to make really, really solid financial decisions. So even if you are making more money, or even if you are gaining more assets, you're still making really, really good decisions with them. So what is the problem with the poor thinker? And I call it the deadly disease of affluenza. And that's also known as keeping up with the Jones. The problem is the Jones are going broke. So if you're constantly purchasing and upgrading your liabilities, you'll continue to limit your ability to purchase assets. So what are hard assets? What are assets that appreciate? These are things like, RSPs, your TFSAs, or your real estate. These are assets that appreciate. And what are these liabilities that we tend to get? Really expensive cars with big payments on them, vacations that we can't quite afford, eating in restaurants a little bit too much. So what we want to do is we want to kind of not try to keep comparing ourselves, and we want to be able to do things that are a little bit more sound, so that we can increase our assets. So how can we do that? Here is my first piece of advice, my income ratio measure. So poor thinkers, they're concerned about income. Like, how much money do I make? Do I make 100 grand, 200 grand? But rich thinkers are more concerned about their income ratio. And what is the ratio? It's when I take all my expenses, this is mortgage, rent, car payments, taxes, and we divide it by our income, and you'll get a percentage. So if you have an income ratio of 60%, that means you have 40% left over to invest or pay down loans, or to build up, to create equity in another asset. So everyone should try to first figure out what is my income ratio, not as what is their income, what is my income ratio? So how can you figure out your income ratio? Well, if you took an Excel sheet, listed out um, all of your expenses going out, and you divided it by your income, you would get a ratio. If you have my budget sheet, which I offered at the last session, it calculates your income ratio for you. So trying to understand and getting your income ratio to be as low as possible, that is my first piece of advice. So since I have Ryan on, I thought that it would be good to shift talking about income ratio and the high income ratio involved in purchasing a home in the Lower Mainland here in Vancouver. I thought that we can get Ryan to talk a little bit about what's going on for those of you who are thinking of buying a property or maybe upgrading a property. Ryan is a great resource to let us know what he's seeing that's going on in the Vancouver housing market. So Ryan, right now it's November 2022. What would you say is happening right now, and where do you think we're going with this, Ryan?
Yeah, good evening. Thanks for having me. It's definitely a slower market. So the last couple of years, people will probably noticed with COVID and everything, we actually had our busiest 2 years ever. And then we started to slow down with these rate increases around April or May. And with these rate increases, the market has slowed down significantly. Some prices are down as much as 25% in the Fraser Valley. And I would say for Metro Vancouver, probably 10 to 15%. So it is slower now. Most of that is rate driven, though, with these increases. There's going to be one more increase next month, they say, and that should hopefully be it. And then once inflation gets under control, the rates will start coming down. We think towards the end of 2023, possibly sooner. So probably what's going to happen and what is happening right now, we're going to be in a slower market for probably the next 6 months to possibly towards the end of next year. But it's a good time for buyers because you're not competing with people. We're not seeing as many multiple offers, and a lot of our buyers are getting pretty good deals. So even though the rates are higher, you're getting able to negotiate a lot more on property.
And Ryan, what would you say is the future outlook on, from your opinion, on what you think will happen with pricing?
Yeah, so it's always kind of hard to see where we're going to end up for pricing because we've had such busy couple of years. So a lot of people are kind of saying we're going to have a crash and this and that. I don't think we're going to have a crash. Definitely the prices have come down more in some areas than others, like the Fraser Valley. I think potentially next year we could go down another 10% with these rates, but I do feel as soon as the rates start to drop, interest rates start to drop next year, that the prices will actually start to go up again, because really they haven't solved the inventory issue, and there's still a lot of buyers on the sideline that do want to buy. They're just kind of pushed out at the moment. So I would say probably 10% next year. We could go down another 10%, but keep in mind when the rates start to drop, the market will most likely turn around pretty quickly.
Okay, no, that's great. Ryan will stay on for a bit. If anyone has a question, feel free to just put it in the chat and we'll circle back. So from an analytical perspective, question, how can you tell if housing prices will go up or down in your area this year? So what I like to do is I like to look at a couple of different stats. So the first one over here is Metro Vancouver's currently holds a 1.148 is the average price across all products. And this is a 2.1% increase from last month and a 9.2% increase. This is a 2.1% increase from October of 2021 and a 9.2% decrease over the last 6 months. So Ryan's kind of 10% down is right on target here. And this is about a 0.1% decrease from September. So if you sort of take a look at these statistics of detached homes, townhouses, apartments, you kind of tell how long things are taking to sell, as well as what the benchmarks now are. Okay. But a ratio that I really like is the sales to active listings ratio. So sales to active listings is a ratio where if the sales to active listings is below a 12%, it means that prices are trending downward, When they're above a 20%, it means they're trending upward. So in May of 2021, all of the numbers were high above the 20% mark. Then if we follow the trend all the way through 2022, we noticed that they kept getting lower and lower and lower. And then as of in the summer, we had the numbers, in similar to where they are right now. 14.3% detached homes, 21.6 for townhouses and condominiums. But what we notice is these trends are slowly heading down. Now, we have had this pullback, but as Ryan predicted, I don't think there's going to be this massive crash. And the reason why, the supply, there's just still not enough supply. So that will always keep rental market in demand. Okay. So some real estate growth consideration is, the GDP in the area, the population forecast, and current housing available. So all three of these are pushing that Vancouver housing is going to continue to do well. Why? Our GDP keeps growing. Right now, the last population forecast that I read said in the next 15 years, we still do not have enough housing to accommodate to the amount of people that are planning on immigrating here. And of course, we have a housing shortage in multiple different areas, which is why also rents continue to keep going up. Why? We're, of course, a desirable city. We're a desirable city. Okay. What real estate considerations are important when starting a family? All right. So here's three that I'm going to highlight on: schools, transportation, and whether you're planning on staying there long-term versus short-term. So it's very expensive to keep moving from area to area. And I kind of find with young families, sometimes they'll say, well, I really want to live in this area, send my kids in this area and settle in this area, but I can't afford it. So I'm going to first start in this area, and then when it's time for the kids to go to school, I will try to move. I'm not sure that's the greatest advice. And the reason is because it'll be expensive to move and you might get squeezed out of that market. My advice, try to live in something smaller that you can afford in the area that you want, or decide to invest in real estate in another area which you can't afford and rent it out, and then choose to rent in the area that you want to stay in. Or if you really like the idea of buying somewhere and living there, and then you want to try to get back into the area that the area that you want to raise the kids, the area you want to settle in, you might want to buy a good piece of real estate that's affordable, that's rentable. And then let's say 5 years later and you want to move because you want the kids to go into that area, you could rent that property out and then move, or you could sell it, use the equity to upgrade. But I think it has to be on the table of not selling, because number one, maybe the other area, ran away on you and you can't afford it anymore. Or maybe that first area over here, it's not ideal of a condition to sell it in. So I don't like people when they get themselves in a position where, the plan is to sell, because if the conditions aren't appropriate to sell, you might get, only pennies on the dollar of what you thought. Short versus long term, I think you always want to consider how you are going to raise the family during that time. I always think to consider, proximity to in-laws. That's always very, very important, because they can save you a lot of money on daycare. Daycare is very, very, very important. So figure out how much daycare costs in that area that you're thinking of living in, and then try to figure out, can you actually afford it? Are you willing to pay it? So daycare costs are somewhere in the neighborhood of $1,300 a month, something like that per child. And if that's not, in your budget, then perhaps we could shave 2, 3, 4 of those days off by living close enough to family that could handle some of our daycare needs. So a lot of people don't think about that, because they're not even, they haven't even started a family. They're not even pregnant yet. But once you buy that house, it's not as easy as you think in order to sell it to be closer to family. So cash flow planning is another huge one. If you're going to say, well, we want to start a family, we want to live in this area, well, go a couple more years ahead. If you have daycare, put the daycare in, okay? Can you still afford to live in that area? The housing expense the housing expense in that area, put that in. Don't just go by whatever the mortgage broker says. Yeah, you could afford it. No, you want to go another layer. That other layer is exactly what you want to look at. So where is this down payment going to come from? There's some various considerations. So one of them, to get faster entry into the market, would be things like maybe ask family, minimize your loan debts, maybe incorporate down payment strategies. Ryan, why don't you give us your insight over here? What have you seen as some creative things to maybe help with down payment or the mortgage or things like that?
Yeah, so to be honest, mainly we're seeing, especially these last couple of years, is gifts from family, which I know is not feasible for every family, but a lot of buyers are getting early inheritance, for example, so that they have a down payment to buy a property. So if you're in that position that your family is going to give you an inheritance down the road, and if that's something that is feasible that they can give it to you in advance, that's always an option. And that's unfortunately or fortunately, that's what we're seeing a lot now, because it's really hard for buyers to come up with a down payment. So even if you have high income and you qualify for the mortgage, the down payment seems to be more of a stretch these last couple of years, especially.
Yeah, one of my favorite ones is this. If you're having trouble with that down payment, but you are willing to make the big sacrifice, maybe even consider living with your folks. If anyone's offering a place to stay, 6 months, even a year, you could save up a pretty hefty down payment in that short period of time. I know for my wife and I, that was how we got ours so quickly. And it all depends, how badly do you want to live and own in Vancouver, right? And if the answer is pretty bad, then what you want to do is you want to make some pretty big sacrifices in order to get there. Some other ones is pre-authorized deductions. That way you're saving first. So if you said, well, we make an extra $1,000 a month and we want to put $800 a month towards our down payment, and then if it's pre-authorized, then literally after expenses, you only have about $200 to play to spend. So that means that everything just gets sucked right out. If you're about to say, oh, my car is about to go on the fritz and I'm just going to renew my lease, or I'm going to go get a nice brand new car, maybe let's delay that purchase. Go from maybe 2 cars to 1 car family. By saving on a car right away, you're saving the gas, which is incredibly expensive. You're saving on the insurance, also incredibly expensive, and you're saving on the depreciation of the vehicle. So right away, there's an enormous amount you're saving if you could just even go 6 months without a car, like you're transitioning between one car and another. Saving on a car is a huge cost savings. Okay, so what mortgage considerations are most important when buying real estate? So I think affordability is probably the first one. So always get pre-approved to figure out what you can what you could afford. But what I always do also is add a stress test. What is a stress test? And I was giving this advice, every single year, and no better time than this year does that stress test come into play. We were having rates as low as, 2%, 1.9% just, 2 years ago. Now our rates are in the 5s. So my stress test couldn't have come at a better time. So stress test your current budget to see if you could actually afford it. Try to stress test the renewal. Now, if you don't know how to do this, then what you need is help. You need professional help of somebody who can show you how to stress test a mortgage. A mortgage broker should be able to help you, but so should get a financial advisor. So let's see what this means over here. Let's say you have a $500,000 at 2.5%, and you had a 20% down payment. After 5 years of a fixed rate mortgage, you need to renew. Now, what if the mortgage renewed at 4, 5, 6, 7? So this is a sensitivity analysis. So the stress test shows that this is how much extra you would have to pay on each of these mortgages. On a 4%, so going from a 2.5 to a 4, it's just $188 extra a month. But on a 5, which is double, that's $385. On a 6, that's $693, and on a 7, it's $808. So if you have that extra cash, then your stress test at least shows that you could afford it. But if you don't even have that extra cash, like there's nothing in your cash flow which shows that you have this amount, then you might be in trouble. Okay, so historically, remember, our rates historically have been quite high. The 7-year average is 7.5. So believe it or not, we're actually still below the 7-year average of lending. It peaked in 1981 and 22%, and it was as low The prime lending rate was as low as 2.25 in 2009. So what's happening in mortgages right now, there was all these hikes that went in April and then another one that went in June. Like back in March, rates were in the 3s. This month, they're in the 5s. The variable rates as well, Future outlook for 2022. There's a lot of predictions that there could be a slowdown end of 2023. And that's because the slowdown is going to be based off of whether federal government can get inflation under 3%. So if we can get inflation under 3%, then they're saying that they will start to slow things down. And that is the prediction right now. It peaked in the 8s, then it went down to the 7s. We're slowly heading downward, but we're not there yet. So end of year, as Ryan mentioned, there could be another hike. We don't know. We'll know soon, though. Most people say that there will be another hike. But what that means is going to be an increase in variable rates. If you have a fixed mortgage right now, then you're not affected. But at the end of your term, that stress test is going to be fairly important. Okay. So always get pre-qualified if you're thinking of buying a property, just so that you have an idea of what it is to expect. That you'll be able to afford. Okay, here's my next question. Should a young couple rent or buy when starting out? And so the quick answer is it depends. It depends on what your greatest priority is. If you carry a lot of debts, and now debts are very expensive, lines of credit, student loans, that's going to be in the 5-6%, maybe you're thinking of upgrading your education, doing that master's degree. Where are your retirement investments? Do you have zero pension from work? Do you have to start saving up for that? So my advice, I'm pro real estate. So my advice is to aggressively save. So that's my first piece of advice. If I was a young couple and I had in-laws that volunteered to let me stay there for free, I would take it. I know it's not ideal, but I would take it. And I would last as many months as I can. If I am in a situation where I can keep my rent low, perhaps having a roommate, perhaps living in that 2-bedroom basement suite as opposed to, that 3-bedroom, townhouse, or I would keep my expenses incredibly low for me to save. And then I would prioritize buying a home over prioritizing, my long-term investments like RRSPs. I've always found that when people buy a home, they've got options, right? They've got the most options out of anyone. They have equity in their home. Typically, if you're living in Vancouver, if you said, well, what if I start investing my RRSPs? See where those RRSPs are 10 years later. Imagine if you invested in your own home, see what the equity value in your own home is. Would you rather have a home and no RRSPs 10 years later, or RRSPs and no home? I am almost positive the home is going to be worth more, and it's capital gains tax free. So remember, as I said at the very beginning, this is just for educational purposes. You do not have to take my advice, but that's my opinion. Because of course a home's got the tax-free capital gain, but you got to, of course, assess affordability of what you can buy. So again, that would come down to cash flow planning. So a CTV report years back said, should you buy or rent? Expert opinions. And what the experts said was, if you have savings and a good job, you should buy. Like if you could continue to be able to afford your mortgage, then you should buy. Even though, people are saying, there might be a crash, there might be, the bubble's going to burst, never happen. And it's not probable. A 10% leveling, which is what we're seeing right now, is absolutely probable. But a bubble bursting, I don't think it's going to happen. If it was, there's not going to be a bubble. It might be a slow decline, and then it'll push back up. If it is all possible, try to budget no more than 40% of your monthly gross income towards your home. 35% is even better. If you run the numbers, in Vancouver, that's almost impossible. Well, what makes it somewhat possible? Potentially getting a renter suite. Okay, that's one way to make it possible. And so it doesn't leave a lot of money left over to do other things like savings, like other forms of investments. So 40% is my rule of what you should try to keep your housing at when you're buying. If you're conservative, try to keep the mortgage at 3 times the household income. This is incredibly hard to do in Vancouver, incredibly hard to do. But with these new interest rates, it's probably, getting more and more advisable. So if you're a household, let's say you make, $200,000 household income, that would only be a $600,000 mortgage. That's it. Plus, you'd have to have a down payment on a nice little starter place, and then slowly build up from there. Okay, my next question is buying investment real estate a good idea with today's prices? So I'm a little bit of a different type of financial advisor. I like my clients buying real estate. I've always been pro real estate. But isn't it too expensive now? Well, the answer is it depends. Depends what it is and depends where it is. So if you said, oh, no, it's too expensive. Do you mean no one is going to buy investment real estate in the next year? Are you saying not one single person is going to make money on the investment real estate that they buy? Of course not. Of course not. So you do got to watch out what you buy. And I'm going to teach you 3 numbers that me and my team look at when we're working with a client. So here's a pre-construction. Someone says, hey, Christian, I found this pre-construction. I got a 20% deposit. It makes $2,800 a month in rental income projected. But we have a 5% vacancy rate, 8% property management fee because they don't want to manage it themselves. And this beautiful property is going to appreciate at 6% per year because it's in the Lower Mainland. So the first number that I like to calculate is the cap rate, okay? Capitalization rate. That's net operating income divided by purchase price. The higher the cap rate, the better the property. So I use cap rate to compare one property to another. Then I look at IRR. And IRR is a way, it's the internal rate of return, and that helps me to figure out what if I just put the money in the stock market? What is this going to do compared to if I put the money in the stock market? And my IRR, if I sold this thing 20 years later, is about 10.74. So you might say, well, that's better than the stock market. But the third number is the one that's going to kind of, kill or make a deal, and that is cash flow. Cash flow changes because mortgage rates change. They change because sometimes rents change, but they also sometimes change because of other factors like high strata fees. So this has got a terrible cash flow, terrible cash flow. So when this place completes, if you can only make $2,800 a month, this thing is going to have over $1,000 of negative cash flow. So can we make this thing break even? Yes. What we'd have to do is we'd have to increase the 20% down payment. We probably have to hike it up close to 40%, 35, 40% in order to make this thing cash flow. And are you willing to put that much money down on one property? The answer is yes, then great. If the answer is no, then maybe we look elsewhere. So this is the type of analysis I do to see, does a real estate property make sense or not? So here, if you see my assumptions, the interest rate, because it's so high, 5.25%, that's one of the number one reasons why this thing is not cash flowing. Does it mean you're not going to make money? Absolutely not. You are going to make money. And depending on the year that you sell it and the closing costs, I could determine what type of IRR you're going to get when you sell this property. So here, what I would then do, if somebody says, oh, I like the idea of buying real estate, but that one that you just showed me, too expensive. I can't afford that negative cash flow. Well, one of the services my team and I do for a fee for service is we help clients to find cash flowing real estate. So this is a condo. I purposely did not put the address on here or the province or the city. This was one we found for a client, $220,000. And it got rent, a very, very good rent of about $1,700 a month. Why is this rent so high? Because it was really, really close to a particular college that had very, very low vacancy. Now, when I calculate this guy, 20% down payment, my cap rate is 5.23, much better cap rate, 13.31 IRR, and it actually cash flows, not by a lot, but at least I'm not losing money. So for people who want to become a real estate investor, if you could find these types of properties on your own, you could do this analysis on your own, fantastic. But if you can't, then you might need help from, a team like mine. Okay, this is another house we found outside of province, $450,000. It got really good rent because we were able to rent out 3 different suites inside of it. It did need some renovations, so we factor in the renovations. And this guy was a cash flow beast, $900 a month extra, 7.19 cap rate, and a 21% IRR, So very, very exciting if you're a real estate investor. Remember, these things aren't like 10 years old pricing. These things are like 2 months old. So the way I calculate return on real estate is I take a look at the cash flow, I take a look at the future value, and then of course I work the ROI, the IRR, backwards. And what I found is that people who own investment real estate mix with the stock market, mix with income funds, they're the ones who actually get the highest return with the lowest amount of volatility over time. So new couple, here's a little case sample. Both own condos. They want to start a family and upgrade their home or invest for retirement. What are their options? So then me and my team will go through and this says, well, one option is sell both to upgrade. Another option is keep one as a rental and sell the other one as the down payment. And the other one is sell one and reinvest elsewhere. Okay, so now we're actually saying, well, why don't I take the equity and going to take it elsewhere? So if you could figure out the answer to this question, then of course you don't need me and my team. But if you said, oh, that's the exact type of question that I wanted solved because I'm not sure what to do with these two condos, we should start a conversation, see if we could help you guys out. What we would do is called a cost benefit analysis. We would calculate each of these scenarios into retirement and see which one you're better off with. And that'll help to guide you with a decision. But we love real estate. Does 2 properties make sense? Yeah, absolutely. Maybe 3 does, maybe 4 does. So what's our real estate conclusion? Don't try to time the market. If you find something that you like and you need a property, over time, it should go up. The question is, can you afford it? Can you afford the cash flow? So with inventory remaining low, prices should continue to be okay. They might have some little bit of fluctuations, but I believe that they're going to go back up. So in 2022, prices will remain. So in 2022, I think what this should say is prices will remain in a downward trend for the remainder of 2022. But then 2024, I believe, especially if we can get the rates back, they'll start to go back up. But we don't really know what's going to happen in the short terms. Don't try to time it. It says, oh, I'm going to wait until Christian said end of 2023. Prices will go down, then it'll go back up. So I'll wait till last. No, they might start going back up next month. You don't know. Nobody knows. But in the long term, we could look back at history and know that it does always go back up. So what am I doing with clients? I'm comparing real estate investment clients across Canada, not just in BC over here. BC is just one market. There's a lot of other markets, a lot of other real estate that you can purchase. Okay. How can a young family budget? Okay. How could a young family budget plan? So here depends on what your priorities are. So paying down high debts, investing in pre-authorized debit, and then spending the leftovers. If you have any high debt, I'm talking Visa card, things like that, you want to pay those down as fast as you possibly can. So first we start with our income and subtract our expenses and figure out our cash flow. We'll also figure out our income ratio. So this is how we should start the budget plan. Figure out income coming in, assets going out. Figure out how much cash flow there is and then reallocate the cash flow. Now, if you're in the negative, you got to figure out how you're going to plug that boat. Okay. So once again, we have our income ratio. Be more concerned about how much you keep, not how much you make. And then this one here is kind of a recommendation if you still had loans. If you still had some high loans, I would prioritize paying down those loans. So notice 35% of my income is going to go towards the loans. So this is an aggressive payback strategy, 35%. If you had no loans, I would have almost 40% going towards housing, okay? Very minimal on the transportation, but I would still leave room for 10% for savings, 10% for investment and savings, okay? How can you financially prepare for having kids? Okay, the first thing you got to do baby proof, stress test your finances, plan expenses ahead, and put your financial house in order. So remember, babies, what they do is they do disrupt our lives in every way, including financially. One of the big financial disruptions is, of course, the temporary loss of at least one income. That's the stress test you have to do. You have to say, can we still afford that house? Can we still afford that car if we stress test what our income is going to be? So our current cash flow and figuring out, what is an appropriate amount of house, what is an appropriate amount of car to buy. Is it appropriate to take that expensive trip this year with the baby coming in 2 years? That's the type of things that you stress test your cash flow. If somebody's going to be on maternity leave, figure out their maternity leave, figure out their cash flow. Are you going to be in the negative? If you are in the negative, maybe you should be saving up. Maybe that's what you should be doing. Yeah. And then do that future projection amount of, okay, maybe someone's going to go back only part-time. If they go back part-time, can you still afford all of the other expenses? So, baby planning. Once pregnant, things to consider: daycare. Are we going to have to use daycare? It's very, very expensive. How are you going to afford the daycare? Insurance. Okay. Do I have to revisit my life, my disability, my critical illness insurance? The answer is yes. Right away, the answer is yes. You should always review your insurance once you have kids. Okay. Housing location. Is where we're living right now going to be adequate for when the baby comes? Okay. So these are some basics to start to think about when you are planning your budget, when you're planning for expenses to come. Babies are actually quite inexpensive in the early years. They don't really take up that much. And because you're not going out as much, you're actually saving money because you're not going to restaurants or as much entertainment or as much travel. But there still are some other long-term things to forecast, okay, such as the ones I've mentioned here. So this segue leads us into insurance, okay? What is the most important insurance to put in place for a young family? So the most important insurance depends on the stage that you're at. So as an example, if you are single, disability insurance is the most important, then critical illness, then life. But if you're married, you've got mortgage, you got kids, life insurance actually then becomes the most important one. So let's take a look at our sample couple, Luke and Jill. So these are two actuarial tables. One's on Luke's life and then one's on Jill's. And at their age, this is the probability of them dying, being disabled, or critically ill before the age of 65. Then at the bottom, we have a cumulative probability. So Luke's has got a 50% probability that at least one of these things will occur before he's 65. And Jill's got a 48% chance that at least one of these things will occur before she reaches 65. And for me, being on the insurance side and having an insurance practice, I can attest to each of these statistics. I'm dealing with claims all the time, and people think these claims are being done by people who are in their, 70s or 80s. No. Last year we had claims of majority of them were under 40. So these things do happen. So, you want to just shift the risk. And right now you're taking on the risk saying, oh, I have some money in the bank, but you're risking all of that money if something was to happen to you, whereas you could just shift the risk to the insurance company. So what we do is an insurance needs graph over time. This helps us to determine how much insurance do you need, and then let's come up with the correct number that we can agree on. So if anyone needs an insurance needs analysis, then that's complementary with our group. We always do insurance needs analysis complementary. And what it does is it says, here's what we're recommending based off of our needs analysis. Here's what you currently have, and here's your shortfall. And then what you decide to do with that shortfall is completely up to you. So why is insurance best put in place when you're young? Because there's three things moving in the wrong direction: your age, your health, and insurance rates. And 1 in 4 policies are not standard policies, they're non-standard. So what the type of insurance for young couples that are first starting out that we always recommend is term insurance because it's inexpensive. After a term insurance policy is placed, you've got several years to figure out what to do with that policy, but at least you're insured. It's inexpensive and at least you're insured. You can convert the insurance as well. So you can upgrade to a longer term or you can upgrade to a permanent. And whenever we do an insurance review, we're never trying to sell you an insurance policy. We could do it over Zoom. What we're trying to do is we're trying to inform you to make an educated opinion. And if you choose to put it in place with us, that's fantastic. So don't delay your insurance if you haven't done a review in a while. Okay, next question. How can you ensure that you are on track for retirement? Well, it depends. What you need is someone to get involved. I don't think most people could do this one on their own. So you need an advisor to say, what are my assets? What are my liabilities? What type of retirement am I planning on? And do I have enough money to fund it? Okay. So what we do, we have the software that helps us to track, well, how much are they going to spend in the retirement based off of how much do they spend now? And then what are the 4 stages of when you're going to need money? Stage 1 is the early retirement. Usually people like to travel. They like to do all those worldly things. So it takes money. But mid-retirement, they want to spend time with grandkids. So they're actually spending quite a bit less. Late retirement, they're less mobile, right? So they're probably not doing a lot of things. So notice how the amount of money you need actually keeps going down. But then at the end, if there's a long-term care need, then it spikes back up. You need to stay in a $10,000 per month facility, as an example. So retirement drawdown is, okay, how is this money being drawn down from? And then me and my associates help to calculate that. This is our summary. So these are probability lines to let us know whether they are on track for retirement or whether they're going to run out of money. But then we make these, recommendations, and that of course gets them back on track for retirement. Should you use a financial advisor? Okay, so slowly we're getting to the tail end of our talk here. So a lot of people try to do things on their own, and you absolutely could. But if there's certain things you cannot do, I highly recommend you use a financial advisor. And if certain things that a financial advisor can do better than you can do, then I highly recommend you use one. So questions to ask is, do your services align with my goals? How often would you meet and what would we be discussing? What can you offer that I cannot do on my own? Like if somebody is investing in a couch potato strategy with the stock market, then you probably don't need me. But if you're not liking the volatility of the markets right now, if your stocks or your funds are getting hammered, then maybe we should talk, right? Right now, they found that if you try to do it yourself versus using an advisor, typically the advisor can add up to 3 times the amount that you could have gotten on your own. And I know that statistic is very, very true with me and my clients because we like to advise a lot on assets outside of the stock market, things that aren't correlated with the stock market. So a traditional portfolio might do a 70-30, stock to bond ratio, or they might do like an 80-20. Then, of course, this is subject to the stock market, and the stock market is incredibly volatile, and they get this mid-range return. Now, with us at Latitude West, we do something differently. We like investment real estate, okay? So if we have investment real estate, we could take a look at our core portfolio, direct real estate that we encourage and help clients buy. This is like condos, for some of them multi-unit apartment buildings, but we help them to buy these things. And then we've got our private funds and our bonds. So how does this really compare is we always will get a higher rate of return with this formula than a standard couch potato formula. So for those people who have money in the stock market, you're probably realizing that it is very volatile, like this one over here. Take a look. So one of the things that we're going to notice is that this thing is bouncing up and down, up and down. But what we like, I don't mind the 8.78% returns, but what I don't like is the 16.5% standard deviation. So this is our core portfolio here at Latitude West. So one of the things you're going to notice is at the time we got this information was the end of September, the stock market was down 14%. Today it's down 20. So it was down 14%. Our core portfolio was up 5%. And right now our core portfolio is up 6%. So what we like is, we like funds that will capture upside, but not too much volatility. So most of our funds have exposure to the stock market, but not nowhere close to, some of these other ETFs that I'm seeing. So this core portfolio has about 40% exposure to the equity market, and that's it. So what else is going inside this? Our private investments. So what are our private investments? Now, so the one thing I want you to notice about our private investments are, since 2009, up till 2022, we've never had a negative year, never had a negative year. And multiple times we've had double-digit years. So this one over here has averaged in the same time frame about 13.5%. And with that average comes much less volatility as well. So if it was 2 years ago, you would have needed $1 million to invest in this private fund of ours. Today, you need as little as 25,000, and it is RSP and TFSA eligible. So I'm not saying to put all of your money into this type of investment. I'm saying to put some of it into this type of investment, especially if you got too much volatility over here. So I prompt you to start a conversation. I'll give you my email at the end. And if you want to talk about the investment class, the core portfolios that we have, as compared to what you're doing in the stock market, I invite you to do so. So what does our process look like? Well, we always start with a discovery meeting, and our discovery meetings are always complimentary. We don't charge anything for a discovery meeting. But what we're doing is discovering what it is that you're trying to do. Are you trying to start a family? Are you trying to figure out where your down payment is? Are you trying to invest in the stock market? Whatever it is, then we try to see, is there a fit with what we do? Typically, we're a fee-for-service firm. That way, we're not biased, and we're not forcing you to do anything that you don't want to. If you don't want to invest with us, don't invest. If you don't want to buy insurance from us, don't buy insurance from us. But what we do want to do is we want to solve your problems. If your problem is, I want to figure out a down payment strategy, or I want to start saving for retirement, or I want to buy real estate, all of those things that we can help, okay? So we start with the discovery meeting, then we navigate a solution, then we implement the plan. That's our process. And that first part, like I said, we don't charge anything. Our hierarchy, we first figure out cash flow, then insurance, then investments, then taxation. So how do my clients utilize me? Okay, well, usually they're always asking me about real estate because we're very pro real estate. What is the best real estate for me to invest in? My own home, some investment property, something out of province. Where do I start with my investing? How do I maximize tax efficiency? Am I on track for retirement? What insurances do I need to put in place? So these are the different ways that clients usually engage conversations with myself. This is what a typical client will often ask me. So now what I want to do is slowly transition. Cap this off. I want to be mindful of people's questions. Have about 10 minutes left. If anyone has any questions, now is the time to put it in the chat. So if you have a question, by all means, put it in the chat. And while people are formulating their questions, I'm going to put my email address as well as Ryan's email address in case anyone would like to reach out to us. So it's assistant@latitude-west.ca. That's how you would, book a time to talk with me. And Ryan@rwrealestate.ca is how you would talk to Ryan. So like I said, if you have a question, feel free to put it in. But one of the things that I wanted to comment on is for you young families out there, if you took my advice and you prioritize real estate, the down payment and the pre-approval are the first steps. Working with the realtor is the second step. Finding the area that you want, but the next step is actually circling back. If maybe the realtor can help you, but figuring out your cash flow, and usually that's a financial advisor's job. Figuring out, do I have enough cash flow in order to afford the real estate that I'm about to buy? And if the answer is yes, then what I say is, can you do the stress test? Do you have on the stress test, can you still afford it if it goes up in value. If the interest rates go up and you can't sell the property, can you still afford it? And I think that's where a lot of people got in trouble in the 80s. And they couldn't afford the renewals when the interest rates went up so high. So at no time in our history has the interest rates shot up this quickly, this fast, except for what happened in the 80s. And that's when interest rates went up. Inflation was too high, so they increased the interest rates, and it got to the point where people were losing their houses. And the only reason why so many people haven't lost their house right now is because they implemented that stress test rule, the +2 rule, where you were getting a 3% mortgage, but you had to qualify as if you could you afford it off of a 5%. And that's why people who want to buy this, $1.1 million place, they were only able to buy a 900 or an 800 because it was a way of trying to keep you in a safe zone. Okay. All right, so I don't think that there are any other questions. Last chance if there is another question on anything that we have talked about. Okay, somebody's asking a question. Is your financial planning services fee only or commission based? So it depends on, so the quick answer is we do have primarily a fee for service financial planning. And people always say, well, what's the fee? It depends. Am I just generating a report, meeting 3 times generating a report for you saying, here's where you are, here's all your goals, here's me solving all these goals, here's what you need to do for retirement, here's the insurance that you need, here's the type of real estate. So if it's just like a report, meeting 1 time, that's 1 fee. But if you said, oh, no, I want to work with you over years, I want to work with you over the next couple of years, and I would meet with you 4 times per year, that's a different fee. There's the one where it says, oh, I also want you to help me to find that really exciting investment real estate that you showed me, Christian. That over there is a different fee. So it's kind of, the fees depend on what it is you want me and my team to do. We can do all of it. So what we want to do is kind of start with a discovery meeting to see, is there a fit? We're the best financial planners for real estate investors. That's who we are, or people with tons of real estate advice. What are your options for other financial planners? Well, I could go to the bank and I get a financial planner. Yes, you can. I doubt they're going to help you too much on the real estate side. On the cost benefit, on, should I buy more rental properties? I don't think they're going to help you. If they are going to help you, great. But most of those guys are stocks and mutual funds and things like that. And the majority of their stocks and mutual funds are completely exposed to the stock market. So they've got their funds are getting hammered right now. So remember, our core portfolio is up this year. The stock market is down. Our other private investments have been up and have never had a negative year. And I think because a lot of the things that we're able to invest in, the bank doesn't, the bank, it's not on the product shelf of the bank. And most of the products that we're able to invest in, the retail investor can't get it. You can't get it from Q-Trade or, online trading, none of those things. They don't provide them. You actually do need an advisor if you're going to have access. And every single investment that I show you guys is net of fees. The core portfolio, net of fees. So yes, we are a fee for service financial planning. But yeah, if we were to do something, let's say insurance, there is a commission that we would make if we were to provide you with any insurance as well. Okay. Was there any, I hope that answers your question. If you wanted to learn more, let's book a call with my assistant, and then we're happy to talk. Okay. All right. So Ryan, thank you very much for joining us. And for everybody that's joined, I hope we were able to add some clarity. For those of you who are young and soon to be married, or young and starting a family, we absolutely wish you guys all the best. Until next time.
Thank you.
All right. Okay. Thanks a lot, everybody. I hope this has helped. And if anyone would like to connect, feel free to just get in touch with us, and we're happy to help you guys. All right. See you next time, Ryan.
Thank you.